6 seconds to go, and the first rates any second will just pop up on your screen. First rates, Wednesday morning, day ahead of its time. Flat start, flat start, flat start. Flat for Nifty, flat for Sensex, flat for Bank Nifty. No one should complain actually. I mean, flat start is actually good news. The breadth is also not looking phenomenal, which is okay. I mean, breadth is not looking phenomenal, but nobody is expecting anything phenomenal. You want to address newsmakers. The newsmakers are Tata Consumer, AU, Tata Consumer, despite good set of numbers, no movement so far. But I think the stock had run. AU, not great numbers, but the market reaction is nothing very scary. In fact, there is uptick in the last tick. And then you have to look at Zomato, not a newsmaker, but the star in terms of the price and the volume action yesterday. And the follow buying is not there. Gland Pharma, I would imagine an ET now impact there. It should be an ET now impact there. If one large owner is not looking at selling their stake in Gland Pharma, the supply in the short term completely gets rebalanced.
But a lot of action in the broader markets. It's Mahindra CIE which is flying away in the trading session for now. 8% higher, a result reaction coming in when the margins expanded by 200 basis points. And then comes the entire Gujarat PSUs. So GSFC, GNFC, GSPL, Gujarat Alkali, all of these counters are up anywhere between 5 to 10%. RVNL continues that solid momentum. It's up another 8% today. So after the 30% run up we saw with the last two trading sessions, RVNL has piled on gains of over 8% today. You also have BSC, which is continuing the momentum. On the downside, MCX is in focus. The CTO has resigned due to personal reasons. The market is not taking it well, a cut of 5% there. And Rallis India, where it was a very, very disappointing set of numbers, is also getting a bit of a drubbing, 4% cut. VSC Industry is also lower by around 3.6% as the company reported a weak set of numbers. Ipca Lab continues the downtrend. Let's see if Crompton Consumer is bouncing back today. The street did not come all the more positive, but the stock is at least holding on to the levels of around 260. And let's pull up Dalmia Bharat as well, because that reported a weak set of number, at least on an operational basis. So opening with a bit of a cut, but then there are bigger cuts from the likes of Shree Cement and other cement names, because probably the street was expecting that margins are expected to be better, but the first number coming in from this entire pack was not very enthusing. So it continues to be RVNL, the Gujarat PSUs, as well as the result reactions that are the big focus points as of this point of time. Nifty pretty much flat, 17,769, though the market breadth is looking prettier.
All right, let's get in our chartists as well and find out what their first trades are as the breadth is skewed in favor of the gaining side. And Kunal, what is it that you're punching in first thing this morning?
So I'll again focus on large cap names. L&T is something which looks attractive. The stock at I think 2350 or 20 to 50 odd mark looks attractive for another at least 50 to 80 points on the upside. So I've been maintaining a bullish stance since I think end of previous week for L&T when the stock had corrected. Would continue to do the same for a target of further 50 to 80 rupees on the upside.
All right, Naresh, let's get in a view from you as well as to what the outlook is in terms of your first trades. Are you looking at large caps too?
So looking at large cap, going in with Bharti Airtel, the stock is trying to make a short-term breakout move, expecting a dash towards 800 to 820 in the short term.
Let's connect with Sunil Tirumbalai, research analyst, emerging market and India equity strategist with UBS Securities. Sunil, good morning. Thank you for joining us. We've had a good comeback in Indian markets from the recent low. What is your view on market and market valuations after the recovery what we've seen from the recent low?
Yes, good morning. Good morning to your viewers too. Yes, so we have seen a reasonable underperformance of India starting end of last year and a recovery, right now. But I think overall, from a relative perspective, when I say relative, I'm talking relative to other emerging markets, other parts of Asia, etc. I think when I look at a framework of what is the earnings growth expectations from India and what are the valuations, I think India is still not super attractive. There are other parts of the emerging markets universe where you are actually getting superior growth outlook for the next couple of years at far compelling valuations. Right. I think I think we still have India as an underweight in our in our EM universe. That Nifty target we have is about 18,000, which is like not too far away from where we are today. I think there has been a recovery, yes, but I think the overall from a valuations versus growth standpoint, I would still not be super positive at this moment.
Valuations versus growth standpoint, it's the risk reward ratio is not favorable. Can you define that for us? And what gives you this kind of a conviction that earnings may surprise, earnings may not surprise on the upside?
Yeah. So okay. So to start with, so the reason why the earnings have kind of held up over the last 6 months to or even a year is because the banks have been reporting really strong margin expansions, right? And I think it's fairly likely that we are coming to an end on that margin expansion story, and hence the support that you got from the banks could start coming off, and you could actually start seeing the rest of so banks are actually hiding the cuts that are happening in many other parts of the index, and those could start flowing through once again. I think the larger part of the index which could still drive earnings cuts could be the commodities sectors, and of course, to the extent that banks margins, there could be some compression. So I'm not arguing for a very sharp downside to earnings, but it's just that the growth upside seems better in some of the other markets than in India, given the context of what we are used to in terms of growth from India.
Coming in, banks, which has been the pillar so far for the markets, might see a bit of a derating and earnings might start to come off as far as that is concerned. Sunil, hi, this is Anisha also joining in the conversation. We were talking about how India has become the most populous country now in the world, how the discretionary spend is likely to go up further. What's your take on consumption and what's the best way to play that?
Yes, I think we are heading into a good time, I guess, for the consumption sectors. Generally, in a disinflationary environment, commodity prices have come off already, and there are more that could happen for some specific commodities for some specific stocks. So generally, we are heading into a good season or good period for consumption sectors. We choose to prefer the staples over discretionary. Given where the valuations, how much to the extent valuations have corrected, and the sensitivity of the stocks to rates. In our work, we found that surprisingly in India, the staples stocks are more rate sensitive, especially when we talk about rates in the US, and which is where our house view is for rates to come off significantly, and hence the tailwind support on valuations could be bigger for the staples sectors, against the discretionary sectors. So I think it's a good time to look at consumption, but I think we would prefer the staples rather than discretionary.
Sunil, morning. Wanted to understand your outlook on the IT sector. Clearly, due to the macro headwinds, it's not been the greatest of starts to the year. What is your outlook in terms of the underlying slowdown within the IT space? Do you think that it is going to continue to flare up and you would thereby remain cautious on the space?
Yes. So, if you're heading into a setup of a recession in the US, and this is a sector which is heavily dependent on the US, on the banking sector, and you're talking about consensus expecting about 8% to 10% kind of top line growth, which pre-pandemic would happen in a decent year. So it was an average year, and this is unlikely to be an average year, right? So I think these uncertainties and pressures on top lines, projects suddenly getting cancelled, customers pulling back, that could be there for some time. So we have it as neutral rated in our picking order, the IT sector, because the stocks have also corrected post result season. But yeah, it's not something that's I would be a bit cautious about turning very positive at this point.
What about factors like buybacks? Could that change the way how IT stocks should be approached now, because these companies are generating cash and doing buybacks?
Yes, so that gives you good support on the downside, right? I would tend to think of buybacks plus dividends as total distributions, and look at distribution yield. They are interesting levels, and they provide downside support. But which basically means that if they correct too much, then you can actually start buying them for that mean reversion. But from a fundamental perspective, I think the picture isn't too rosy.
A lot of banks are saying that there is no problem with the credit cycle. The 14 could become 13 and 15 could become 14, but the credit growth for FY24 looks solid. And when I look at brokerage opinions, whether it's UBS or Morgan Stanley or others, they are of the view that banks have reached the peak of their earnings. Do you think we are in for a surprise there?
So I think so the peak of margins is what I think I would definitely agree with, and that's what even our banks team have been talking about. But on asset quality, it doesn't seem like we should be worried, at least from a 12 to 18-month perspective. And if you look back historically, asset quality cycles have been the bigger drivers of banks' performance than just margins, right? And you would be worried on the stocks if they were trading super expensive at a big premium, and hence even the correction on margins is a big risk, and you have to get away from the sector. I don't think we are at such a situation right now. So we actually have banks as one of the most preferred places for us in the market. Primarily because the credit growth, given the kind of nominal GDP growth that we have in India and the penetration levels, I mean, you'll get decent credit growth. We should be more focused on asset quality cycle, and that's where we should be kind of comfortable from the next 12 to 18 months perspective. And I wouldn't use the margin speaking and coming off as a big sell argument on the bank sector. I think the valuations are quite compelling given the context of where the valuations are in the rest of the sectors.
Okay, fair enough. Getting a sense as well as to what your outlook is for earnings as a whole. What makes you pessimistic and of the view that we're likely to see big earnings cut in FY24? Because just this morning, we were alluding to the fact that, yes, Infosys may have been a big washout in terms of one of the big tech Nifty numbers that came out. But by and large, you can't use the same brush to stroke the entire gamut of Nifty companies. It's not across the board. So what makes you confident that we are likely to see those earnings cuts?
So, yes, I mean, I think let me rephrase myself. I'm not talking about, very big earnings cuts, going forward. I would say where consensus is today for FY24, by the time we end FY24, we should probably have seen about 5 or 6% earnings cuts, which is par for the course. That's how normal sell side behavior is. What I'm talking about is that the level of earnings growth that we are talking about in India looks reasonably ordinary compared to the kind of earnings growth that we are getting in other parts of the world, and hence for example, over the last 3 to 6 months. Other than the technology sector in emerging markets, which is basically semiconductors, etc., which have seen sharp earnings cuts, most other parts have actually not seen cuts. They've actually seen increases, right? While India has continued to see some cuts, right? So that is the visibility and strength that is actually available in other markets. Whereas in India, that confidence on growth outlook and earning sustainability, I think that's a bit weak. So I'm not talking about risk of very sharp earnings cuts, but it's just that the earning growth outlook is not as attractive as it is in other parts.
It's been pretty interesting, and day after day we're seeing some of these railway stocks seeing a lot of traction in trade, a lot of progress, for instance, on the Vande Bharat trains, coaches starting production, etc. Wanted to just understand your view on this theme as a whole. How are you looking at the promising prospects that have been doled out by the government for sectors like defense and railways and infrastructure?
Yes, so I think government is one entity that's definitely doing a lot of capex. I mean, we haven't found much evidence of private sector and private corporates doing a lot of capex. And neither are there commentaries indicating that a big upsurge is seen. So yes, I mean, it makes a lot of sense to look at opportunities in the government capex space. I think our team likes, I mean, without getting into stock names, our team definitely likes the defense area. It likes the metro area, etc. And yeah, I mean, we do have positive bias on the industrial space as a whole. And there are some pockets of private corporate capital expenditure which can lead to some niche opportunities where our team is positive on. But I think at an aggregate level, it's the government space for CAPEX which is really making sense right now.
All right, appreciate your time. Thanks very much, Sunil, for joining in and giving us your take on the markets as a whole, as well as your outlook on the earnings. Meantime, just want to check in on the markets. And as things stand, you've got Hindalco, JSW Steel, Tata Steel. So the metals basket is looking a bit weak. Reliance Industries is down about 1% or so in trade. We're down 0.5% as well for the mid-cap end of the market. And while Rail Vikas Nigam continues to power through, you've also got something like an Ircon International giving it company. Check in on a Lemon Tree Hotels as well. We've been talking and reading a little bit as well about how the leisure segment is really propping up. So hotel companies across the board, the Morgan Stanley report on Indian hotels giving it a thumbs up, that as well is being taken into consideration. That's stock a buzz. RCF is another mover on the upside, and Spark is comfortably in the green. Some of those Gujarat-based stocks as well, a buzz like a Gujarat Alkalis, while on the flip side, IPCA continues to reel under pressure. VST Industries result reaction, ditto with an AU Small Finance. Rallis India is down about 3%, and IGL along with Adani Transmission are some of the other losers. Rahul Chadda, then Chief Investment Officer, Mirae Asset Investment, believes that the next few months will be very challenging for the markets. Let's listen into his view on individual sectors.
I think next 3-4 months would be challenging, and I think we saw that in IT services result, where there is a sharp demand slowdown which has happened in recent months, and I think it continues. US economy is slowing further, and likely that probably around fourth quarter of this year or first quarter of next year goes into a mild shallow recession. So I think that is where the slowdown is going to come in the Indian economy also. That's largely going to come from weakness in exports, and that impacts the job creation around it.
What should be the best investment strategy? There is a visible fear in IT, but there is a visible growth in banking. There is a visible slowdown in rural India, but there is a visible uptick in urban India. What is the best way to stay put in this market?
I think the best way to stay put is take a medium-term view. Look, near-term is going to be challenging, but that is where you get entry points. Most of us been saying that for a while, but look, in markets you don't make money every day, every month. You make money in spurts, and this is what we've got to understand. But if you're not positioned for it, you miss those spurts. And I think somewhere those moments are going to come either in the fourth quarter of this year or the first quarter of next year, when Fed worried about slowing growth and inflation becoming less of an issue, starts cutting rates. And that's where things would improve. And I think the rally here is going to be led by domestic cyclical. So we've seen strong set of numbers come over the weekend by the likes of ICICI Bank. Reliance has also done a good job. I think these are the names which would take the market to the next level.
Rahul, when we spoke to you last, you were about 30% of your exposure was in banks and financials. Now that investment has worked. But now, are we reaching at that pivot point where financials will slow down, the base effect will kick in, deposit growth is slow, economy is slowing down? So one side, there is merit in recognizing that financials are core to everyone's portfolio, but are best of the gains behind us?
Definitely. Fourth quarter last year, which was 22 or first quarter of 23, is going to be best for financials. NII growth is going to slow down from here. You would see these banks build up more contingencies also because some of the delinquencies are going to pick up. But look, life's relative. Such is going to be the slowdown in other sectors. But our view is, unlike the previous cycles where a lot of excess investment was done and it took a while to come out of that down cycle, we've not seen India or US done much of those excessive investments. It's largely in China where they've done the over investment, which is where growth is going to slow down. And I think that's where, even if a down cycle comes, which is going to come in coming quarters, it's not going to be that harsh.
Rahul, are you surprised with the kind of IT reportage we've seen, the commentary from TCS as well as Infosys, or do you think that was well anticipated?
Yeah, but to be fair, our sense was till Feb, these guys sounded very bullish about the demand outlook. What happened was we had this mini banking crisis in US, the SVB crisis, and post that, some of these discretionary projects were put on hold.
All right, now give me great pleasure to bring on board Sunil D'Souza, Managing Director and CEO of Tata Consumer Products, to talk about how things have transpired for the quarter gone by. I can see the shelf of the range of products every time they keep on innovating and introducing. Secretly, I was hoping that there would be Bisleri there this time around at your back, but unfortunately that deal has not happened. We'll talk about that, Sunil, but first, good numbers. I've got two brokerage reports in my hand. Both of them are appreciating what you've done in a tough quarter. Walk us through what has worked for you, what has not worked for you.
Nikunj, actually speaking, it's been a topsy-turvy year, so to speak. I mean, geopolitical tensions, inflation, everything that you can think of in terms of volatility, commodity, currencies. But at the end of the year, the last quarter, I think was, we brought it in quite well. 14% top line, 13% EBITDA, 21% group net profit. Even for the full year, we've delivered 11% top line, 30% group net profit. If you look at our financial numbers, we've got working capital down by 3 days. We've converted 99% of our EBITDA to cash. We've upped our dividend this year. In terms of the strategic priorities, we said 4 million outlets. Now we are 3.8, close to the 4 that we're committed. Innovation is now 3.4. We are in the top quartile of the FMCGs. So in this quarter, if you look at specific businesses per se, India business, beverages, tea specifically, back to volume growth, 1% volume growth, 3% revenue, and margins almost coming back to normalized. Salt, we had taken aggressive price increases, and I think the team executed very, very well. Despite the price increases, we've got 7% volume growth, 24% revenue, and share has gone up by 77 bips. International, we've done a lot of work in the last, I would say about 3 quarters to combat all the inflation, the volatility there. They brought in 6% top line, and more importantly, EBIT for international is just 100 bips off where it was the same quarter last year. So severe cost actions, pricing actions starting to pay off. India growth businesses fired on all cylinders. Again, 58% top line. The ready to drink grew by close to 90. Sampan grew by 35. All in all, feel pretty good about where we are as we enter FY24 and hoping to continue to deliver strong results.
Sometime last year, when we were talking about FY23, the conditions were different. There was a war in the world, commodity prices had reached unprecedented level, tea prices were topsy-turvy, there was no growth, there was contraction. Are you confident that FY24 will be a significantly better year than FY23 in all parameters, growth, volume, margins, international business?
Nikunj, I always tell my team, you focus on what you can control and don't worry about all the externalities that will happen. So we're focused on making sure that we execute our strategies very well. Now, in specific terms, I think most of the volatility has got baked into the numbers, whether it is commodity, currency, etc. We're seeing that volatility come down a bit, inflation starting to slow down. It's not still going down, but I mean slowing down, and all the algorithms that we baked for next year take all those into account. In specific terms, I had said we'll watch for about 1 or 2 quarters before we say that volume growth is back, and I do think volume growth is back. Last quarter, beverages grew, salt, like I said, 7%. So I think the rural stress in India is beginning to come off. I don't think we're out of the woods yet, but early signs, number one. Number two, from a commodity perspective, I think the big moves happened with the geopolitical uncertainty and then crude moving all over the place, having a downward impact on everything else in the supply chain. That I think has got baked in. So salt, for example, now we are seeing more or less flatter costs going forward. Tea was all over the place because we had floods, we had drought, and Sri Lanka went out of the market all of a sudden, again raising prices. I do think this year will be a relatively easier year. Now, again, I'm keeping my fingers crossed there. And international, more importantly, we've taken aggressive pricing and structural costs. So macro environment can't predict. I do think it will be less eventful than last year, but internally we are very, very strongly focused on execution. Just to give you a perspective, right now we're in the top quartile of innovation. We will climb still higher. We said 4 million outlets. We'll be at 4 million. But more importantly, now that we've got a big portfolio, we're going to split our routes for food and beverages in all 10 lakh plus towns. So that will provide extra focus. We're going, our weakness was semi-urban and rural in distribution. We are going to appoint distributors in all 50,000 population towns and going down to 20,000 population towns in some geographies as well. So all in all, I do think this year will be better.
Let's put things in perspective. In a tough year, you've given volume growth. In a tough year, your margins have improved by 70 bips. And that year, like you said, topsy-turvy, tough year to call, lot of crazy headwinds. This year is going to be a good year. In a tough year, if you're growing, in a good year, what will you do? It's a logical question, right? You'll appreciate the spirit of the question.
So, Nikunj, more than anything else, I think I've got a very supportive, but very, I would say, ambitious board as well. So, we've got strong internal numbers. We will continue to deliver double-digit growth and flow that down to the bottom line. And more importantly, we are looking at market share gains as well this year.
No, I was hoping for a slightly more direct answer. In a tough year, which you called as a tough year, you've grown, you've done well. These are your numbers. In your questions, you are calling this to be a better year and a reasonable year. In a tough year, if you're growing at double digit, margins have expanded. In a good year with new products and with new distribution, will this be one of the best years post-COVID for Tata Consumer? That is what I want to understand.
So Nikunj, just in perspective, when my team comes back to me and says we've had our best ever quarter, I said for a growing company, every quarter has to be a best ever quarter. So yes, this year will be the best ever, but that's not saying too much for a company which has high ambitions.
Okay, hi Mr. D'Souza, this is Anisha also joining into the conversation. I just wanted to deep dive when it comes to your beverage business, because while there has been a volume growth after 2-3 quarters of decline, it does seem like that you're losing the market share there. Could you talk to us about what's the strategy going forward for the beverage vertical?
So very specifically for tea, when you look at market shares, you also look at the geography mix. We are stronger in the north compared to the south, and north is where there's more rural, there is more stress, etc. And just from a mix perspective, we've lost share. But even that, to put it in context, for the full year, volume share loss was only 50 bips. So it's not a very significant number, number one. Value was more because we gave up pricing as tea prices came down. Now, two things going forward. Like I said, I expect that tea costs will trend marginally lower if there are no unforeseen climatic things like droughts and floods, etc. That should aid margins, number one. Number two, like I said, I do think we are seeing growth coming back, especially on the rural north belt, etc. And we always had stress on the bottom of our portfolio. We are now seeing volume growth at the bottom of our portfolio, coupled with advertising, coupled with distribution expansions. We remain confident that we'll not only claw back that share, we intend to expand from here.
Okay. Mr. D'Souza, I wanted to also understand what the outlook is in terms of the pace of expansion plans when it comes to Starbucks, because that has clearly been indicated as well in the presentation. Can you just give us more perspective on the capex that's slotted for this and how many stores per year?
So Starbucks, after 10 years now, we've crossed the 4-digit mark, right? We're north of 1,000 crores. Number one. Number two, we added the highest number of stores this year, about 75 stores. And now we are in 41 cities across the country. We will continue to expand store numbers aggressively, going close to the 3-digit mark. Number one. Number two, we ran a pilot to make sure that we are able to pull in more consumers to Starbucks stores. That pilot was extremely successful, and now we will roll it out in significant number of stores nationally. This consists of basically 4 things. Number one is expand the beverage offerings, because not everyone who wants just coffee. So we will have milkshakes, we have masala chai, we'll have filter coffee. Number two is people were not very comfortable with the sizes of coffee there. So we've introduced a smaller pico size that has done very well and not cannibalize the higher sizes. Number three, Indians look for sharing and fresh options, which we have now provided for. And the other thing was in many of the tier 2, tier 3 cities, as we went in, people found the interiors a bit intimidating. So we're brightening that up, and that has a good impact on consumers. So apart from aggressive store opening, we will also have these four parameters play out in a significant number of stores. And we do expect, again, a very high double-digit growth for Starbucks as well.
What about the inorganic growth opportunity? You have 3,400 crores lying on your book. The Bisleri deal is out of the picture at this point of time, but have you completely given up your, your direction to get into the water space? What's the strategy going forward?
So first I'll talk about the inorganic growth ambitions per se. We've always maintained that Tata Consumer will always explore new opportunities, both organic and inorganic. Internally, we have built a cereal platform, we have built a protein platform, we built a ready-to-drink platform. That's organic. But on the organic space as well, we continue to be in discussions with multiple parties, looking at options on how to expand our portfolio, expand our total addressable markets, and grow very aggressively and become one of the top FMCGs in the country. Specifically on the beverage space itself, like I said, Narishco, which is our ready-to-drink business, is now 600 crores plus. Just to put it in perspective, when we bought out PepsiCo's stake in end of FY20, it was 180 crores. So from 180, we've now reached 600, and we're still not where we should be. We're still expanding aggressively. Tata Copper Water doing very well. Tata Gluco Plus doing very well. Himalayan, again, 50% plus growth, and now starting to tick very, very profitably. So yes, right now we will focus on expanding our footprint and our innovation in this space. And I would say in the next 3 to 6 months, you will see an aggressive set of products coming out in Narishco, which will play across different consumer segments.
Good to just, quote a very famous line from Indira Nooyi a couple of years ago, and when she was heading PepsiCo, and she said, we know our missing piece was protein, and they expanded the entire protein business. Is water that missing link for Tata Consumer? Because if you would have gone ahead with the Bisleri deal, it could have been a game changer for your distribution business, your product business, and the profile of the business. I mean, if Bisleri deal does not go through, does your ambition into moving into water business, does that change? Or you would say, okay, I'll give it a skip, I'll build on something else?
So Nikunj, first of all, we aim to be a large food and beverage company. It's not only a ready-to-drink beverage company. So we're looking at expanding organically and inorganically as well across different product segments in food and beverage. That's number one. Number two, I would say it is not only water, it is ready-to-drink beverages. Like I said, we've got Gluco Plus, we've got Fruski, and I'd say watch this space in the next 3 to 6 months. We will be expanding aggressively. Yes, what would have happened with the Bisleri acquisition, it would have given us a jump shift and a very strong third leg in India, tea, salt, and ready-to-drink beverages. But now that is not happening. We're probably 3 years behind. We've just ramped up our entire investments, both in terms of the footprint and manufacturing expansion, as well as the product expansion. So in 3 years, we will be close to where they were.
Sunil, I'm a very happy consumer of Tata consumer products. From makhanas to ragi chip biscuits, I enjoy it all. They are occupying more and more place, at least in our breakfast and on our dining table. But aren't you spreading yourself too thin? From dry fruits to makhana, from salt to pepper, from besan to lal mirch, aren't you spreading yourself too thin?
Nikunj, it might look from the outside, it might look as if you are spreading yourself too thin, but we are very, very focused on building very, very specific platforms. So one is the core. Second is the pantry platform under Sampann. So all the points that you're mentioning, whether it is makhana, spices, pulses, etc., comes under Sampann. So we are focused on building the Sampann brand. Number 3, we are focused on building a ready-to-drink this thing, and it operates separately under Narishco. Number 4, we are very, very specific about breakfast, cereals, mini meals, and snacking, which is under Soulful and a little bit under Tata Smart Foods, which is now Tata Yum Site, Sampann Yum Site that we've launched. And we've just sort of wetting our feet in the protein space. Protein space, we've got a long way to go. We're still not putting major money there. We're just testing it out. And the way we are structured internally, organizationally, and the way we go to market, I think we are very, very well poised to deliver on each of these pieces.
Sunil D'Souza takes over Tata Consumer. He fixes a lot of things: distribution, cash flow, product profile, introduces soul food and the product range. But he also promised our viewers and his shareholders that he will bring Tata Consumer at par with what the industry averages are in terms of return ratios. How soon will you fulfill that other promise? As a consumer, I'm very happy. I've got more Tata Consumer delicious products on my table, more tea varieties. I'm perhaps having one as we speak, having it in ET Now cup, a Tata tea. But the shareholder promise.
So two things around that, Nikunj. That still remains a target, yes, and we probably missed a beat on that piece. And like I said, this was a eventful year, and we didn't make progress very much on return on capital employed, for example, and that's precisely because in terms of the inflation which bit us, number one, and number two, the cost items that we had to tackle didn't come through. But as long as we continue to deliver strong double-digit growth, hold costs very strongly, returns will flow to the bottom line. Just to give you a perspective, some of the targets that we had stated, right? Working capital, when we started, we were 59 days. Right now, we are close to 34, 35. Other than headcount costs, where in the India business, we're about 11. Today, we are 5.5. So as we build scale and synergies, we are seeing efficiencies come in. It's just that this year was eventful on different line items of the P&L, and therefore the return ratios didn't come through. But that does remain a target we need to deliver.
When we met last, we challenged you to brew a cup of coffee. Now that the product range has increased, what should we challenge up to you?
You name the beverage, Nikunj, happy to serve you anytime.
Look forward to meet you in person, and thank you very much for your time.
Thank you, Nikunj. Always a pleasure.
Okay, thanks Mr. D'Souza for joining us. We'll take you up on that offer rather soon, and with Nikunj probably we'll also tag along given the Starbucks and the other beverages.
A very nice coffee for us, and told me the secret that if you want more foam, how much you have to really balance it between the foam and the steam. It's actually quite scientific. The heat and the speed that's required to really generate the foam. I mean, the heat in terms of the temperature and the speed at which you change the knobs to get the steam out. I used to think, cappuccino is simple, just put it, not like this.
But I'm sure we'll get all those trade secrets out when we meet him the next time. But for now, let's take a look at what the market is doing at this point of time. Not too, excited. In fact, we're at the lowest point of the trading session, threatening to go below the mark of 17,700. But we have a mega lineup for you. So without further ado, let's slip into a very short break. When we come back, we'll discuss the earnings of AU Small Finance Bank.
Now Sanjay Agrawal joins us now, Managing Director and CEO with AU Small Finance Bank. Sanjay, good morning. Thank you for joining us. The big smile on your face has come. Is it after the 3-year extension after RBI?
No, I know, Nikunj, you would be asking me this only, but of course, yes, I got relief, and the reasons, but I think it's a public platform, and when regulator trusts you, the board trusts you, the customer trusts you, the entire ecosystem trusts you. It's a very special feeling. So I'm enjoying that space now and look forward with more determination to build one of the finance institutions of this country.
Last year look was different. After extension, your look has also changed, is it? New extension, 3-year look, new look, right?
That I don't know, but that's my way to handle myself. So no, it's good for you guys, right? You don't want to see the same face every day, right?
But shareholders want to see the same aggression every time when we interact with you and every time we discuss your quarterly numbers. Correct. Quarter gone by was strong on loan growth, margins, asset quality. But is this as good as it gets purely because of the cost of deposits? Purely because of what's happening to the interest rate cycle? Is the best of the earning uptick behind you?
Oh, no. I don't think so. But because, we are in journey, Nikunj, we are new franchise on on the road. Just 6 years has gone by. We are still learning this platform. We got to the level of what now, close to 69,000 crore of deposits. We've gone around 60,000 crores of assets. We are able to build our digital platform. So, and there are not much investment being done on many initiatives like credit card or video banking or, the other digital initiatives, right? So we are into that investment mode. And of course, the last year became tough because the overall cost gone up. But I think we are very solid in terms of overall approach, the business model, the sustainability around it, the people, the product, the markets. So I think just give us maybe another 2 to 3 years, and you will see that once we reach one scale, I think same market, same people, same thing will give you better returns, because when the cycle will be over, so our credit card should become profitable next year, right? And, we will start monetizing our QR code business and, we'll start building more a digital franchise than a brick and mortar. So I think overall, I'm very optimistic around our whole future and, and the way we handle ourselves in such 6 years, that gives us more hope,
Sanjay, but just to get into specifics, your loan growth rate has been 20-25% over the last 2 to 3 years. Is that maintainable? And also with respect to net interest margin, should we expect a contraction of 30 to 50 basis points this year, given the cost of funds?
So if you ask me that the first foremost focus area for me is to build deposit, right? And that we are growing, very fairly well. Last year also we grown by 32%, right? So I think this year also, in spite of the higher rate cycle and, the lot much challenge there, but I hope that, we can grow around the range of 28-30% in deposits. And then, our asset franchise is solid. We are doing that business from last, 28 years now. So I don't think that we should have much challenge around asset build-up, because we have diversified book, it's well settled, asset quality is one of the best. People are there on the road, and we are building our franchise more robustly in terms of our brand and all those things. So I think I'm too much optimistic around my asset. It's more about rationality. So we just want to grow in the range of 26-28% there also. But of course, if cost goes up, there can be a pressure on NIM because, we lend a market like, 14-15% it's not easy to actually transfer the incremental cost to the customer, right? We need to hit our balance sheet too sometime. So there might be a 30-40 bips NIM pressure this year, but I think the other factor will play in, right? We can have, because the insurance, we are selling insurance very well, so we can have a better earnings from there. We can have an AD1 coming back. It has AD1, we just got the license of AD1, right? So I think their income can be also be there in Q3, Q4. So I think overall, our ROA can be protected. Of course, the form can be very different.
Okay, so the bottom line being that the 26-28% growth on asset side is sustainable. There might be NIM pressure to the tune of 30 to 40 basis points, but you're more focused towards building your deposit franchise, and that remains the key focus area for you as well. You talked about getting the AD1 license as well, but then separately there were reports talking about how RBI is watchful of the kind of growth that you have reported when it comes to the asset side as well. Could you talk to us about what are you doing with respect to risk management? How do you expect the asset quality to pan out from here on?
No, to be very honest, we are well diversified in our asset build-up, like we are running a wheel book from last 28 years. That book will only grow by 20, maybe around 25%, right? SBL is a secured business loan business, right? Which is also from last 15, 16 years. That will also grow by 25%, right? The commercial banking space, which we started as a small finance bank, which is just coming up, right? That may grow in the range of 30-35%. So I think we have a well-diversified book. 92% book is secured. We deal at around 14-15% IRR. Historically, our asset quality has not deteriorated at all, even in the bad of the times, So I think if you ask me, the overall asset is there where we get most of our comfort, My challenge is not asset and asset quality, to be very honest. My challenge is to really build a brand where people trust us more and more. we get a low cost deposit. If we get a low cost deposit, there will be an automatic sustainability of this platform, right? So if you ask me, as a risk is more on deposit and the cost than an asset and its quality.
But your cost to income ratio, let's say it's 63%, it has gone higher. When will the cost to income ratio is also a function of scale and size. As you will grow, it will change. How far are you away from that curve where the cost to income ratio starts really, coming down as the base
2 years.
increases?
2 years, Nikhil. Because next year, as I told you that, our credit card will become break even. 81 will start coming in. There is much rationalization around insurance distribution income. Our wealth will come and start kicking in. Maybe next year you'll see some help from the cost of money also. So I think overall, I believe that it's very nearby. You will see the positive impact on our cost to income coming maybe from next year itself.
This environment where the fight right now is not, the fight within the banking system is fight of liabilities. Who gets more market share of liabilities? Would you be forced to increase rates? Would you be forced to give better fixed deposit rates or saving rates? It's like, it reminds me of that old Kotak Bank. It is not 2% more, it is 50% jada. Would you be forced to do something on similar lines?
No, I think we are already around that. So we give you saving rate around 7.25. We are giving you 8% deposits. We are a small finance bank. Still long way to go. We are able to build a decent brand, but still people need to believe in us. That is why in my narrative last night, I said that give us more 4 years, because banks are not built in 5-6 years. They need some good runway, which may be around 10 years, right? So I think I would say that we have to price deposit right, but it is not that we need to price high, right? We need to build other hooks, maybe through loans, maybe through digital outlook, through credit cards, through everything, right? And now 81 coming in, Nikunj, I think it completes our entire product side. We are not lacking now any product, right? Till now we were not able to handle EXIM customers, the payments, the remittances, right? So I think you will see, AU is not playing only on rate. Of course, we need to play around it, but we are building other hooks so that customers start believing that AU offers them complete solution.
Question. It is still known as AU Small Finance Bank. A small finance bank can grow because India is growing, but then for you to become a large formidable player, you need to be a complete universal bank. Do you see that happening in 3-4 years?
Long call, Nikunj. And being a cricketer, I always believe that we are executives like players, right? And we need to go and perform on the platform which is given to us. It's up to the selector, which in my opinion is the board, the shareholder, and of course the regulator to decide that what platform is good for us. So I'm happy running the largest SFB of this country, and much can happen in next 3 to 5 years, but difficult to comment as of now. And by getting 81, we have completed our whole product solutions. There is nothing left between us and the universal now. Of course, small sometimes plays negatively for us, but I think as we move forward for more in this inning, people will start building up a better opinion on SFB also.
Sanjay, like your new look, and next 3 years, congratulations. Your stock, when that news came up, was up 20%. So obviously everybody's excited with the extension of your tenure.
Thank you so much, Nikunj. I hope I'm able to build that trust people are showing on me. It's a wonderful feeling, that people trust me so much and they believe that AU can build one of the most fascinating story for this country.
Well, congratulations. Well, Mr. Katpalia also joins us, and it's not planned, just a coincidence that we are talking to Mr. Katpalia also after he's got an extension from Reserve Bank of India. Katpalia sahab, the discussion was not planned. It just happened by design that we have Sanjay and we have you after that.
Okay.
So
Hi Nukunj.
So what should we start with, sir? Hinduja Group increasing stake, quarterly numbers for IndusInd Bank or the fact that you got an extension from RBI? You can choose. As anchors, we normally choose today. It's the other way around.
No, I can. You can decide the order, and we can answer all the questions.
Great. Let's start with quarterly numbers. Let's understand the environment. It's been a good environment for banks, but is this as good as it gets? Do you think going forward the base effect and the cost of liability could have an impact on margins and credit growth could also slow down?
See, the system credit growth may slow down, but you have to look at each organization in a very different way. If you look at us, we have domains. Our domains are coming from cyclical lows. So for example, the CV cycle or the microfinance cycle or the diamond, they've all contact businesses and were affected during COVID to a large extent. What we've seen in the last 12 months on the CV cycle, or we are now seeing with the rural economy recovering in the rural banking segment, and I think the diamond starts coming up with the lab diamonds coming into play, I think you will see a very tremendous growth. And I think we are very, very comfortable with the growth projections which we've given 18 to 23%. And that is where we think we should be able to do the growth. In addition, we have consumer businesses which are growing at about 35% because they come from a small base. And we are entering into MSME and SME, which have actually grown by 8% quarter on quarter. So I think we have very well diversified of portfolio with domain specializations, which I think are coming from cyclical lows for us to give the confidence to the market that we should be able to maintain the growth which we are seeing in the market.
All right, morning, Mr. Katpalia. Let's also discuss the outlook when it comes to your overall deposit growth, which has been robust in the quarter. The cost of deposits have been higher by about 34 basis points sequentially. How much higher can it go from here? And would you say that to a certain extent that this deposit growth is eating into your margins to a certain extent?
So let me first talk about the margins, and I think you will understand. We have maintained, if you look at last 8 quarters, our margins have been very steady between 4.15 to 4.25, and that's been our guidance, and we've been able to maintain. The book is such that our mix of the book gives us the margin. We have a very well balanced book between fixed and floating. So 51% of our book is fixed, 49. What happens is you see stability of margins, and that is what you're seeing in this bank, a very stable margin scenario between 4.15 to 4.25. Having said that, our cost of deposits are higher than the market because we are in a granularization journey. I believe that a large balance sheet needs to have granular deposits. We continue to focus on granularization of liabilities. We are today at 43% as per Basel III. We want to get to 48 to 50% by the end of 3 years, which means that there are 3 or 4 things which we will do. We will continue to expand our branches. We will continue to give right rates to our clients. We will launch a digital proposition called Indy, and we will do another very innovative offering called community banking. And I think very differentiated approach, very differentiated capability to continue to create liabilities of what extent we need to manage our growth.
But just on the net interest margin bit, what I find a bit intriguing is the fact that while other banks, other peers are talking about a bit of a contraction, you continue to maintain there is going to be an expansion there. Could you talk to us about what kind of expansion can we see in the net interest margin? What's the sustainable level, 4.5 thereabouts?
No, we said that our guidance for the parent cycle 6 is 4.2 to 4.3. So we will be in the margin range of 4.2 to 4.3. We were in the margin range of 4.15 to 4.25. I think we should be able to deliver 4.2 to 4.3. Please understand, while the fixed rate growth will give me the margin, the floating rate both, if the interest rate changes, will have a decline in the interest rate. So I think it's a well-balanced book, but because the mix is changing towards consumer, that's why the margin expansion will happen.
From your standpoint, if you have to really talk about the credit cycle for next 2 to 3 years, do you see a mid-teen kind of an credit growth and a possibility of very low NPAs? Is that a possibility for next 2 to 3 years? Can investors be reasonably sure whether it is IndusInd Bank or SBI? But in general, the trend is going to be strong and NBA concerns are not going to be there?
So I think we are in a benign credit cycle. However, for the bank, if you look at it, the contact businesses have had some flows. So if our gross flows, if you look at it, they're still on the higher side at 1.7 to 1.8%. I continue to believe that you will see the gross flows moderating, specifically in the MFI side, where we had 600 crores of gross flow this quarter. You would see that going down to about 200 crores next quarter, because our 30 plus has gone down to 1.1%. So I think over a period of time now, with the contact businesses stabilizing and the restructured book declining to less than 1%, I think for IndusInd and for the industry, I think the next 12 months at least, I cannot talk about I think the next 12 months you will see a benign credit cycle in the industry.
Are you happy and also disappointed that Reserve Bank of India gave you an extension, but instead of 3 it was 2?
See, you can look at a glass half empty or half full. The board applied for a 3-year. I think RBI did its due diligence and found that it is appropriate to give 2 years, and we have to live with it. So I'm happy that it's not 6 months or 1 year. So, and 2 years gives you enough time to what you want to do.
Clear the area, sir. Now 1 year, 10 months are left, which means the board will have to again apply for another extension for you soon.
Yes, within the next 18 months they should apply.
Okay.
Mr. Katpali, we understand that RBI has also allowed, Hindujas to increase the stake in IndusInd Bank. When is that expected to happen? Any timeline that you can help us with? Is it likely to happen in FY24 itself?
See, first of all, I think there is a little bit of a communication or a misunderstanding out there. I think there are circulars which the regulator has issued, which allows promoters to apply for a stake rise. As our promoters too have applied for a stake rise and filled up the forms which were required to be filled in. There is no communication from the RBI or any approval from RBI as of now that they can increase the stake. It's in the process, and as and when the process gets completed, will we know what is the status of that application.
So whenever the approval goes through, and Hindujas will be about to increase their stake, there are 2 ways you can increase your stake, sir. I'm just breaking it for the viewers. You can buy from the open market because they have cash, or you can, or the bank can do a fresh approval. What would be the route?
So I think you should ask them this question. I think if the past precedence is anything to go by, Hinduja, the IHL has always subscribed to the primary issuance, have never bought shares in the secondary market.
Need capital. Would the bank go ahead with the primary issuance, because bank does not need capital?
So that is the question. You're absolutely right. I don't think we need the capital, because our internal accruals are enough to take care of any growth right now, which is the organic growth. If there is an inorganic growth opportunity, and we are evaluating an inorganic growth opportunity, is when we may need capital, or our board feels that we should raise capital because the CET1 at certain point they want to maintain above 16% or 17%. But otherwise, I don't see us raising capital in the next 4 to 6 quarters.
Raising capital in the next 4 to 6 quarters, because for now you don't see any inorganic opportunity, etc. But my colleague Ankur broke the story yesterday that there could be organic expansion that you could be planning and foraying into the MF insurance as well as broking business. Could you clarify that or confirm that for us? What's the rationale, what's the strategy, what's the timeline of getting into these new businesses?
Again, these are para-banking activities, and para-banking activities does require the regulator nod for us to get into this. We don't have the regulatory approvals as of now to get into the para-banking activities. As and when we get the para-banking activities, we will come out with a strategy as to how we want to take the para-banking activities forward. Yes, like you rightly said, we like the brokerage space because we are into the wealth management. We like the non-life insurance space because we do a whole lot of non-life insurance for our partners because of the vehicle finance business which we have. And I think we like the AMC place because it's very capital efficient.
Talia, have you made those applications to the regulators? What stage are those applications at? Anything you can clarify in terms of the timeline for us?
We have not made the applications. We are in the process of doing the due diligence before we make the applications.
We always compare banks with the industry average, and for a bank of a balance sheet size of yours, what to your mind will be the growth for the industry per se? And then if you can indicate to us what your growth would be, because I distinctly remember, so the criticism which shareholders were or analysts had about IndusInd Bank was that, why is it growing slower than HDFC Bank when the balance sheet is much smaller than HDFC Bank?
It depends on the type of businesses which you do. I think, Nukunj, it is very easy to say. We were in contact businesses, and our contact businesses, which is 43% of our portfolio, got affected during COVID. And we were not able to access those customers. That's why the slowdown happened when buses are not plying, when when trucks are not plying, or you cannot reach your microfinance customers. You can't see growth in those segments. I think, having said that, I think the credit growth in the system would be around 13 to 15%, and we have given a guidance of growing at 18 to 23%, and that's what our guidance is. And I believe that IndusInd will always grow ahead of the public other banks, because A, we come from a small base, and B, our domains are coming from cyclical lows, and we believe we want to continue to maintain or gain market share in these domains.
There is a buzz in the market. When the stock of Karnataka Bank, Federal Bank, it goes higher, your name is connected. Why don't you clear the air once and for all that you will not buy any listed bank and there are no plans?
You can continue to comment on every rumor, but that's not what the style we use. I think if there is anything which we are doing, I think it will be an open thing in the public. We're not doing anything right now which I think it requires us to make any comment in the public.
Clock back and take the clock forward. I'm going to take the clock back for the benefit of our viewers, that there was a high growth period for IndusInd Bank, then came the LNFS crisis, then came the 2018 slowdown. You had to re-engineer, retool your balance sheet, your growth and everything else for risk management. Then came the COVID in the repair phase, where you were able to really grow and build upon your microfinance business, your diamond business. See how much I try IndusInd Bank. Your microfinance business and other things. But next 3 years, how will it be different for you? Sir, before you answer the question, you'll agree with me that I track your bank very closely.
4 things, I think.
You'll agree with me, I track your bank very closely.
Yeah, Nukunj, the new way to track the bank is how much have we diversified. So if you look at microfinance business now, the microfinance business was a JLG business. We have now turned that into a micro banking business. So what you are seeing now is the bank has diversified into what is called as merchant acquiring business, where 4,000 crores of book has been created, and this in the next 3 years will be 15,000 crores, and which comes at a yield of about 23 to 25% and a fees of 4% with a current account balance sheet. The ROA of this business is 7%. You will also see launch of liabilities, you will also see launch of home improvement, and you will also see launch of scooter loans in the deep rural area. So I think a microfinance business will grow at 25 to 30%, but the JLG portion of that business will become 55 to 60% rather than 90%. So I think that's one change which you will see in the business. The second change which you will see in the business is diversification of the vehicle finance. And you would have seen that already. In LCV, where we were 1% market share, today we are 9.5% market share, and we believe we will be 12% market share and will be a domain leadership for the bank in the next 2 years, and we believe that we will be number one next to Chola in the LCV business. We have launched used car business, and we believe that in used cars we are early entrants, and we believe we can make a very good blueprint in that. That also comes at a 15.5% yield in the business, and we're already doing about 600 crores a month. I want to take it to 1,000 crores. I think the way we've diversified a tractor portfolio, we're already at 9.5% of the tractor. I think we have done different things. On the diamond, we're taking a community approach and not a diamond approach. So I think community approach means that we will finance the ecosystem, which is from the employees to the vendors, to the real diamonds, and to the outside diamond, to the gift city. I think that business will become a very cohesive business in itself. So what you will see, growth will come from domains, but I think the growth will come in a very diversified manner. Then I think our cards and PL has been a very slow business, and I think you've seen the scale up. We've launched mortgages. You will see a book of rampant growth in the mortgage because it lends stability into the book, and we're scaling up our SME and the MSME segment to become 35% to 40% of our book from 20%. So I think the bank has enough levers to show the growth, and I think the bank will become very well diversified and will continue to be in line or ahead of the market in the growth phase, and in the domains we will gain market share.
I'm going to wrap it up with just one final question, a leaf from your answer. The three differentiating businesses of IndusInd Bank. Number one, microfinance business. We know there is a rural slowdown. Second, the auto finance business. You spoke about the numbers there. You've got a very large book there. But that's one space where luxury cars are selling, two-wheelers are not selling. And the third, in a sense, some would say is the diamond finance business, where we know that America is in a recession and the diamond exports may not be that great. So these are three differentiating businesses of yours which do have a macro tailwind. Am I right? Headwind, not tailwind, sorry.
Not at all. You'll be headwinds, but I think not at all. If you look at the diamond business, I think that's where the ecosystem is coming into play. And while US may be in recession, I think we are seeing a huge demand from China and UAE for a diamond business, and you will see the growth happening. And of course, the government is supporting the growth of the lab diamond, which is also a very differentiated offering. On the microfinance, I've said we're becoming a micro banking, and I think while rural economy is recovering from a slowdown and is coming up, but I think the differentiated and the well-to-do businesses in the rural area, which is the KCC, which is the scooter, the personal mobility, as well as the lending against warehousing, I think is fantastically doing very well, and we believe that that's a huge opportunity in that. On the consumer side of the business, mortgages business will continue to grow, and on the vehicle side, we've diversified the book in such a way that no stoppage or no recession can actually stop. In the month of April, which is the worst month, we still are seeing the disbursement which we would have seen normally in the month of October, November, December. So I think the diversification of our book have really helped us make sure that we continue to build the scale and continue to see the scale in these businesses.
Well, yeah, always a pleasure to have you on ET now. And must say, sir, we've been talking about meeting for coffee and for a dinner. Let's make it happen this time, sir. I'm going to send you an email and perhaps take some time.
Yes. And you've forgotten to say one thing. I think the bank produced the best ever results for the quarter.
Sir, ye thi jordar awaaz. Best ever results and that real kadak awaaz to end the show with.
Yes. Thank you so much.
All right, let's take a break. Best ever results from IndusInd Bank, and things are looking up for them. Let's look at the stock, and the stock should react post these numbers. I mean, brokerages are saying that it's a stock jiska samay aa gaya hai. Let's take a break for them.